what I'm going to do is I'm going to unmute them,
All right,
and if they
so
want
oh,
to
we're almost
talk
we're
about
actually pretty
their
on schedule. So let's take
experience, some of
a
them
five
have
minute break.
information regarding what they do, where they're from. I know there's some people here from the UK, there's some people here from Africa, so it'll give you an opportunity to connect with them afterwards as well, because they'll be in the other groups, but they'll just give you a little bit of background, some expectations of what they want to do. So, you're up, Mr. Forex Six God. How are you?
Hey bro, how are you?
I'm good. I'm good. So just Alex, go ahead and just chat for a bit. Let them sort of know your experience. I know you've been very active and working hard with a lot of people. So I think it'd be a great idea to sort of give your background, talk about a little bit what you do and how you've been working with this and all the success you've been having and all the pain you've been having as well.
Oh, okay, sure. Thanks, Ted.
No problem.
Yeah. So, my name is Alex. I'm Kirui from Kenya, Africa, and I've been a part of the Forex family since I think October. And the experience that I had before joining the Forex family was everything was downhill. Like I didn't know what I was doing as far as Forex was concerned, and I really needed some guidance and mentorship. And when I met Ted and we talk, and yeah, I signed up for the webinar in October, and I accessed all the materials that you guys are going to get in the drive, and it's really life changing, you know. And I just want to tell you guys, like, if you put in work, um things will happen. Like you will get where I am right now, or where Ted is, or even much better. And I just feel like for you guys to be here with us, I think that's the best decision you guys ever made in your lives. As long as you just put in work and dedication, it's hard, but eventually you'll get there. I'm yet to get there, but I'm almost halfway there. So for me, I just want to encourage you guys and tell you that um there is no shortcut. Like this is success. Like you're already halfway there, and I've been consistent. Like from let's say January up to now, I've been having let's say one or two losses out of like 600, 700 trades, and that's something else. And I just want to tell guys, especially from Africa, man, like this concept is not yet here, and we are the pioneers. And for you to actually um get success in this, you have to be real with yourself and legit in your own beliefs. Don't let anybody tell you you can do this and you can do that. And as far as I'm like concerned, Forex is real, man. Forex is real, and it has changed my life. And I'm just grateful to the Forex family and Ted and all the other guys, Rakil, Raghav, everybody else. I'm just grateful. And so with that being said, I'm just welcoming you guys to the Forex family, and just let's have a ride, and we can connect. Um, I may be joining you guys in the groups. I'll talk to Ted about that, and yeah, this is the Forex God here, and I wish you success in your trading journey.
Perfect. Thanks, Alex. I think there are people here from Africa, so I will make sure that you're connected with them as well, and they will also work with you. Alex, I think trades selective pairs based on his plan, and I mean he'll talk to everybody on that because he'll be in some of the groups, and I know he's starting to try and get some movement with in Africa and build out some things out there for him, and these are the things what we try and do as a group. You know, I promote and I support everybody that does that. I don't, this is something that he undertook himself and that he wants to do. It's great that he's doing that. And anything that he needs from us, we give. And, if he's going to mentor people or if he's going to do whatever he's going to do, he has the full support of us, and that goes for everybody moving forward. This is a way to learn and get better, and everyone can then help each other. So, I mean, he'll definitely go through some stuff with you, and like I said, he just wanted to talk to people about what's going on, and you guys will all connect, and that's why we use Facebook as the chat group. It's just easier to get everybody together, and everyone connects, and everyone starts to really get to know each other. So, I mean, it's a great example of someone who, like I said, in October joined my webinar, who now I consider a friend, and we've talked about different things, and I've helped him just in general with other stuff as well. Just so it's, to see him progress like that, that's important for everybody, and I treat everybody the same. And the people that put in the effort, like Alex and everybody else, we're all brothers, we're all friends, and like I said, all around the world, we're trying to do what we need to do. It sounds cheesy and sounds cliche, but it becomes you're against the market. It's important that you realize, like, you have people here, like 400 or 500 people now that are like-minded. We have to battle the market together. We have to band together. So if there's information, you don't hold it back. You share it. You make everybody work a little bit harder. So I think we're doing that. I don't know if there's anybody else. I don't know if Anthony wanted to talk. Anthony's from the UK. Anthony, do you want to go? I unmuted you, Anthony. Do you want to talk?
Yeah, I'm
There.
fine. I'm fine. Let me stop my stopwatch so I don't go over 2 minutes. Can you all hear me?
Yeah, I think we can hear you.
Right. First thing I want to say is, well done for joining, guys. I mean, probably the best decision you ever made in your life. And what Ted says is absolutely. I'm not one for blowing smoke up anybody's arse, but Ted's absolutely bang on. All of the mentors, everybody's here to help me, help everybody else. They'll help you as much as they help me. The biggest thing, as Ted said, is the mindset. He can teach you, anybody can teach you how to draw support and resistance and what have you. The trader's mindset is really key. You'll get all the materials that you need to be able to do that. Study much, much harder than you ever have in your entire life. Ted will go over building a trading plan. Hey, the guys will even help you build a trading plan, whatever works for you. Listen to your mentors. When you get put in your groups, there's people in there who know more than you, less than you, and leave your ego behind. There's people who are 16, 17, who are millionaires, multi-millionaires, and those guys are great. They'll take the time for nothing. They're after nothing but to help you. It's a fabulous place to be. And like I say, I'm not trying to blow smoke over anybody's arse, but just do as hard as you can, put as much effort as you can, and you'll be rewarded. And everybody's there to help you. That's all I had to say, really. And, I'll help anybody as much as anybody else will.
Yeah, thanks, Anthony. And I know Anthony is out of the UK. He's working hard. He's actually building a group out there, just because there's a lot of people in the UK, similar to like in Toronto, that meet up and do stuff. So he's building that out there, and there's a lot of people in the UK area and out in Europe that want to get together. So I'll definitely have him in some of the groups, and you guys can touch base with him. If there's people in the UK that want to work directly with them, that's fine as well. I think it's important that everybody has that opportunity. So thanks, Anthony. I appreciate it.
You're welcome.
Yeah, so I see people, yeah, everyone wants to. Oh, yeah, so, oh, wow. What is this? I think we have a special guest. Is this the Forex God, Rag?
I think this is him, if you can call me that. But I'm more of a pit burglar, if anything.
Yes. So
Yeah.
guys, this is Rag. He runs his own mentorship as well. So the thing, there's a little bit of dynamics with the Forex family. Elias, myself, Rag, Rakeel, there's a couple other people. We all run various mentor groups, but we're all in all the groups together. We help each other. But the thing that separates all of us is if you pay for my webinar, you get my webinar information. But if you pay for Rag or Rakeel, you get their webinars. So we trade information back and forth, but it just makes it easier on everybody. So like I always say, you want to try and go with who you want to work with. We all share information, so it's not like we're hiding one from the other. But like webinar stuff and like this, like things that we take time to build, it's more of just a courtesy that you go to that person and you pay for that information. But they'll work with you on a daily basis. But a little bit about Rag. Probably one of the best guys I know in terms of just genuine hardworking. He's got a lot of grief. People once again bother him on Instagram because of what he does or how he does. But I think he's a prime example of someone who's young, ambitious, who built a trading plan and did his own thing. And I think it's important, and I mean, I'm happy that he's here just to talk a little bit today, and he'll give you his experience. And I mean, definitely feel free to reach out to him as well. He'll be in the groups helping out as much as he can because he's got all his groups. But he's another great resource and a very, very powerful mind. So go ahead, Rag.
If anyone has any questions or anything, please don't hesitate to hit me up. Wherever it may be, I'll always make time for anyone who, is definitely willing to learn. But yeah, a little bit in terms about, my trading career per se, if you can call it a career. I think at this point you can. But I started trading about 4 years ago. I was in high school when I started trading equities, things of that nature. I was a little bit skeptical and a little bit sort of held back from getting in to trading currencies because you have these different misconceptions about how there's more risk and stuff like that, deregulation and things of that nature. However, I mean, there's a lot more financial scalability. Um, from my perspective, the problem is that, I think, maybe a problem and it's definitely advantage to many people. There's a low barrier to entry in Forex, right? You can start a small account with really, a mediocre sum of money. There really, and there's really more sort of opportunities because of leverage and things of that nature and how overall the industry is structured to become successful. But you have misconceptions, you have different perspectives and different perceptions on how to trade this and that. I'll tell you right now, there's no right or wrong way to trade, quite honestly. It's really all about finding your edge as a trader and finding a strategy that makes you successful and makes you profitable. If you find it profitable to only aim for 5 to 10 pips a trade, and you can do that consistently with a small win percentage, and that's completely fine. But I think from the get-go, you really shouldn't be orienting yourself around making the money. You should really be sort of orienting yourself around becoming exceptional at analysis, finding a strategy, and really developing consistency, and really learning how to position yourself to capitalize on highly probable moves. That's really sort of what I sort of recommend that you guys focus on. I know a lot of people see the amount of money some of us are making, see the type of financial success that is possible in this industry, but don't let that cloud your judgment, right? I know at the end of the day we're trading money, right? But the actual pursuit of money isn't what's going to make us exceptional traders. The pursuit of becoming exceptional, developing a strong, consistent strategy, becoming great at conducting analysis. That's what's going to make you a great trader, and that's really what you should focus yourself around doing, from the very beginning. And that's what I sort of tell everyone. Right? I mean, it's all about sort of education, all about the consistency, and that's really what's going to, help you develop your own sort of ideas, your strategies, and provide you with your own personal edge. The money really is tempting and things of that nature, but I really recommend that, as a new trader, it's important that you just orient yourself around, becoming extremely educated. But I promise you the money will come. I mean, for me, it took a lot longer for me to find my edge than it did for other amazing traders, Ted, Rakeel, Elias, so on and so forth. Sorry if I'm missing any one of you guys. There's a lot of you who I look up to, but it took me longer, quite honestly. It took me about 3.5 years or so before I finally that code finally clicked for me. But now that I look back, I really realize that what made me have a larger learning curve was because I situated myself around materialistic pursuits in the beginning. um, per se. I mean, that's just really, I started when I was young, so I guess the money was really something that attracted me towards trading, and I guess the perceived um, limitless scalability, you could say, with uh, trading in general. So, I found myself pursuing things that I thought could really make me a lot of money, rather than just orienting myself around, what could make me a great trader, because we're all here to trade. But yeah, that's really my 2 cents around the subject. Um, but yeah, I mean, it's gonna be a lot of hard work, and trading is in my opinion one of the most mentally strenuous and stressful occupations you can really take up upon. I found myself when I was really sort of grinding it out, when it really clicked for me. I was studying and um, really looking at things for like 18 hours a day for like a month straight. All I was doing was living, breathing, um, and just existing for the purpose of excelling in this industry. But it's a lot of hard work. It's definitely very strenuous in that sense. But you also got to understand it's a very introspective process. It requires a lot of self-reflection from the get-go. Um, for example, I mean, your personal situation, your personal circumstance, your day-to-day life, and your finances and stuff. Those factors are gonna, impact the way you trade and how you conduct yourself as a trader, how you perceive things, how you perceive risks. So what I really recommend is when you're sort of building your strategy, building out your trading plan, you're reflecting upon all these things. It's really an introspective process, and each strategy needs to be individualistic and oriented around how you perceive things and how you can best, position yourself to reach all of your objectives. That's truly what it is. I mean, that's why I always say, and don't copy someone's strategy. And Ted says as well. I mean, don't try to mimic what works for someone else. We go, what works for us, what works for me won't work for you, and what works for me doesn't work for Ted. What works for Ted doesn't always work for me, and so on and so forth, vice versa, right? It's all about finding individualistically what's going to enable you to become profitable. And everyone has their learning curve. Everyone has their own way of perceiving risk, own ways of handling, stress associated with, different monetary risks, so on and so forth. And it's important that you find your own sort of balance within those things, so you can position yourself to succeed on your own terms. Yeah, that's really all I have to say. Yeah.
Perfect, right? Thanks a lot. And I mean, once again, he'll be available to help you guys, and he'll be around. So I mean, like I said, I've had the opportunity to work with Rag a lot, and very, very astute mind. And I think it just shows that we have, you know, the various people in here to come in and help out everybody. So thank you once again. Next we have Kevin. I think Kev is from our US of A, so I think you guys will enjoy having him chat with you guys. But he was from my last webinar groups. Very, very hard worker as well. So let's bring him on. Hey, Kev, you okay?
Yes, Ted. Hi. Hey, how's everyone doing?
Good. Go ahead, my friend.
Hey, so first of all, Ted, thank you for everything you've done. Thanks to everything you showed to the group. We always hit you up and you always respond in a timely manner. Guys, this is the best investment you could ever make. I could tell you for a simple fact, I've been trading probably for the last 7 years. I lost about maybe 70K in the market, and I'm still struggling to find my way. I am profitable with Ted, but I'm not hammering these trades out like everyone else. I could tell you that the simple fact that I'm taking my time as a trader. I actually reach out to his previous students a lot more than I reach out to Ted. Like Ted said, everyone is everyone here is willing to help you. I think I have a good relationship with Rag. Anytime I need any help with anything, I reach out to Rag. Actually, I just got off of a webinar with Rag, studying and going over some trades. Guys, feel free to reach out to any one of these guys. No one that I ever reached out to in the past has ever said no to me. So utilize these guys. I utilize most of these guys that's successful more than Ted. I just feel a lot comfortable going towards a student because they share their struggles with you and what you're overcome. I know as a trader, I'm overcoming entries and actually holding my trades. So I actually think I found my niche. So today, I'm excited for the market to be open to see if I could utilize what Rag just told me on this webinar that we just got off of. So guys, utilize it. I'm surprised Ted could charge probably tens of thousands of dollars, and it's still, I'm thinking people would still sign up for it. Like for him to charge, I think 450, 500 is undermining it. Like I'm not exaggerating. No one paid me to have this conversation. I'm genuinely appreciative for what Ted done. I was a little bit skeptical when I first signed up for it. I'm like, okay, it's gonna be some next MLL crap. He's gonna show us this. He's gonna provide some nonsense. But trust me, guys, the material is mind blowing. Like I studied 24 hours, guys. I probably took two to three trades last week. I'm studying more than I'm taking trades because I want to make sure that when I hammer the markets, I want to be a profitable trader. We're all going to get into this, like from the previous students, what Ted just showed you on the webinar. You'll be like, oh man, it's so simple. No, it's not simple. I could tell you that I was one of those who was like, oh man, I have to look at the wicks and the previous wick closed lower. Oh, that's a trade. No, it's not. Take your time, guys. I could tell you that in January, I almost blew my account. I had initially started off with about 10K, and I draw down to about 8K, and I had to deposit some more money because I almost blew my account. Now I'm up to 20K, and it's not because I'm an experienced trader. It's just I'm just taking those little trades at a time. So guys, take your time, please. It's hard to blow. I had to lose over 70K in this market. It's not easy. It's hard-earned money, guys. Take your time. The market's not going anywhere. I could tell you this. I probably won't take a trade today. I'll probably look at the charts till 6 p.m. Eastern Standard Time till 5 in the market, just to see the trends and see how the market goes. Not everyone can trade gold. Stay away from gold, guys. I almost blew my account with gold. I focus on UJ, and that's still a volatile pair, but take your time. I'm telling you this. Take your time. The market's always going to be there. It's not going anywhere. The most valuable information I think I've taken away from Ted is the news. I remember a couple years ago when the Greece exit came out, I was trading options and I didn't know anything about news and I lost $30,000. But take your time, guys. Learn everything that Ted is willing to teach you guys. I think there's a doc in the drive that called the first thing you need to start with that. It's very valuable information. And once again, guys, reach out to anyone. They're willing to help you, from Rev, Zeddy, Kevin, Ted, Daniel. All these guys are willing to help us. At some point, they was just like us as a struggling traders, and now they're successful. So just take your time, guys. The market's not going anywhere. Thanks, Ted.
Thank you, Kev. It's interesting because people come on here and they talk about the various information, and Kev's exactly right. I mean, and Anthony said the same thing. We're not trying to do anything crazy here or do anything that's out of the ordinary. It's really, at the end of the day, trying to help everybody. You're only going to be as good as the weakest link. And I've always professed that. I mean, I'm a little bit older than everybody else, and there's people here that are older than me now that are in the groups. And we mentor each other, we talk about life experiences, but it's nice to have exactly what I've said, the support of everybody. And, he, like you said, he reaches out to other people. He does what he needs to do. He, maybe he doesn't want to bother me. I mean, I never say don't bother me, but, he's more comfortable talking with somebody else because maybe he relates to them better, and that's not offensive. Like, I don't get offended by that. I think it's great that people have those relationships within the groups, because at the same time there's groups that have formed on their own because people have gone off and they said we want to study together, so we'll be part of this group but we'll also be part of that group. So I mean, it's one of those things, right? You just sort of do what you think, and it's whatever you decide to do and how you want to do it, that's sort of your own track and your own course, but we're all here to help you out. So I don't think there's anybody else here that wants to chat. I'll wait to see if there's anybody else that pops in the chat box. If not, we'll move forward. Okay, I don't see anybody, but Oh, does anybody else want to chat? No? Okay. Going once, going twice. Sold. Alana said she sounds horrible, so okay, that's fine. You don't have to chat. Okay, so next we're going to go through and talk about battling the institutions and institutional trading. So I think this part of the webinar you're going to probably watch a couple of times. It's hosted by Dave and Wes. I don't know if Wes is going to join us today, but Dave is around. He will be talking about this. He really dives into the art of the big banks and the way institutions think. Dave is a very astute trader as well. He's in some of the groups. He runs Mastermind FX, and there is something that we're working with Mastermind FX that we want to build something greater for everybody. So we're in the works of trying to do that. I'll let him speak a little bit to it and really help out that way. But other than that, his information that he has is very informative. It's a little high level, so this is probably the most advanced you're going to get in terms of trading and understanding and knowledge, but he's very good at what he does. And like I said, this is something you may want to watch twice or three times just to get an idea and a sense of what the institutions are doing. And go from there. And we can definitely talk a little bit more about it in the groups, but I'll bring on Dave. Give me a second here. Let me see if he's here. Dave, you available?
Yeah, I'm here, Ted.
Okay, perfect. So what I'll do is, do you want me to transfer over the screen to you, and you can take over and sort of do your thing?
Yeah, just give me 2 minutes.
Okay. All right, we'll give you 2 minutes. Oh, he's muted
Okay,
himself.
I'm ready. Sorry.
Okay, perfect. So I'll transfer the screen over to you, and go for it, Dave.
Okay, let me know when you guys can see my screen.
Yeah, give me a second.
Yeah.
Make presenter. All right, so Dave, you got control, so go ahead.
All right, perfect. Thank you. So you guys can hear me? Let's do a quick check.
We can all hear you.
All right, perfect. So basically, a little bit about my background. I've been working with Ted for, I would say, about 2 years now, year and a half, 2 years, regarding Forex. We pretty much started at the exact same time. I was trading in the stock market to begin with, just buying and holding stocks, nothing too crazy, mostly just paying attention to the fundamentals and things of that nature economically, and that's how I got my start in trading. And then it ended up branching into the foreign exchange, and that's basically where we're located today, is mostly in the foreign exchange. The barrier to entry was a lot higher in the stock market and equities regarding competition. It's been publicly tradable for a lot longer, and the foreign exchange has been something that's more of a recent phenomena that used to be allocated only to very high net worth individuals and mostly, if not all, institutions. So that's pretty much what we're going to be talking about in this section here, is just giving you guys a little bit of insight on economic data, why it's important, technical analysis as well, and mostly just everything to do with institutions. So this is just a website. We're going to come back to some of the material at the end. We also have an Instagram if you want to check us out after. So that's a little bit about who we are. These are some of the topics that we're going to be talking about. And that's basically where we're going to start, is right into the institution. So some background on how the institutions move the market, how they trade, why it's important to pay attention to them, and really the size of what they're trading with compared to what most people are just familiar with in the retail market. So here, an example here is a scenario that some fines got passed out to the biggest investment bank in the world, JP Morgan. They're located in the United States. They had a very, very massive trading loss from a single trader at one of their offices. It's called the London whale because it was in London and the size of the trade was basically the size of a whale. So, uh, as I said, JP Morgan's an investment bank known as a market maker to traders. Their assets under management are accumulated from individuals, small and large businesses, governments, nonprofits, which are spread over deposit accounts, loans, credit cards, mortgages, capital markets advice, and mutual funds. So with JP Morgan's total assets under management above 1 trillion, over 70%, which is 700 billion of these assets are actually invested in trading and very, very high risk. And we're going to get into why it's traded and why they have so much risk actually in the market. So all trading affects the movement of currency, whether it's stocks, options, futures, equities, everything that's tradable ends up factoring in and affecting the currency market. That's why it's such a massive liquid market. So the bank leverage is 50 to 1. So they have about 50 trillion active in the markets. So just because they have, $1 trillion doesn't mean that they only have a portion of that. They have their leverage basically up to 50 to 1 where they actually have market exposure of over 50 trillion. That's just one investment bank, by the way. So in the late months of 2011, there was a single trader working for JP Morgan. He lost a string of trades, resulting in a $6 billion hit from a single trader. With very little regulation and loopholes, too easy to capitalize on for the large funds and investment banks. It makes it an easy decision for them to put the majority, 70%, of their assets at risk in the trading markets. Since the investment bank's assets under management are so large, so many groups or individuals have their money invested in these single firms, the government concludes that the banks are too big to fail and allows them to conduct their investments in where they see fit. So you guys can clearly see, just from the topics talked about today, how in-depth and complex the market can seem. And it's not just for you guys, right? So in the political offices all around the world, they have, a very, very hard time trying to figure out how they can try to cap risk exposure in these banks as well and things of that nature. Trading, from what we are going to be discussing, is very simple and straightforward in the methodology that we approach the market with, but trading as a whole to try and understand all of the different strategies and risk exposure in a lot of these profiles, not just in Forex, but in equities and so on and so forth, makes it hard for regulatory bodies to try to regulate the investment environment. So because too much regulation would cripple the economy of growth, such as the need of investment from these firms and companies with IPOs or publicly traded on the market and the government keeps regulation very low in order to keep the economy stimulated and growing. So with the financial crisis of 2008, many investment banks collapsed, resulting in one of two options: either global depression from the failure and foreclosure of over 245 organizations, mostly including banks or government, or the second option was a government bailout using all funds from taxpayers' money. So obviously the government chose the second option, resulting in $700 billion taxpayers' money to bail out these institutions. With some of the largest investment banks in the world topping the list, JP Morgan trumps them all. They received $25 billion in taxpayer bailouts. So the government bill, the Emergency Economic Stabilization Act, allows banks of enormous size to be bailed out with taxpayers' money upon any failure that they cannot themselves pay off. So with this bill in place, and regulators too fearful of placing any regulation that would slow the economy in place, the banks move the majority of their assets under management in risk profile, knowing that regardless of the outcome, it's a win-win for them. So if they over-leverage, they win, and if they default, it's taxpayers' dollars that's going to be bailing them out. So with the 2011 trader known as London whale as a prime example of how banks still have not changed since the 2008 crisis, Mention all of this to give you a very clear idea of how big this industry actually is and how maximum incentives after 2008 are given to the bank traders to get the highest returns with no chance of failure, which results in higher volatility in the market, making it obviously the best time for all of us to be traders. So with JP Morgan as one of the many large funds and banks trading in the market, you can see how they make the majority of their money, which is in trading, and how they move the markets. So when they place orders, noticing that a single trader had access to over 6 billion and took a $6 billion hit. So you can imagine with the tens of thousands of employees they have and the hundreds, if not thousands, of traders that have access to that amount of capital, how much they actually have leveraged inside the markets. So here's the government bailout bill of 2008. These are just a list of like the top, I think 15 or 20 organizations that received bailout money. You can see on the top here 965 recipients, 621 billion dispersed. 390 billion has been returned since the government gave them that bailout, which had no interest on top of it either. So it's basically a free loan from the government of billions of dollars of taxpayers' dollars. And then the total revenues from dividends, interest, and other fees is 303 billion that was given out. So obviously that goes to show you that they were actually incentivized not only from being paid out from taxpayer dollars, but secondly from actually continuing to make the wages that they make without really taking any hits. So you can see I've highlighted a couple banks on here. You've got JP Morgan, you got Citigroup, you got Bank of America. Bank of America was the biggest investment bank that got the biggest bailout, 45 billion. JP Morgan, 25 billion, Goldman Sachs, 10 billion, and Morgan Stanley, 10 billion. So that's just an example there. And here's a Wall Street Journal article showing the 2015 annual report has Deutsche Bank, which is a massive investment bank in Europe. Their exposure to derivatives currently is 41 trillion. So as I was saying, there's some proof that they are actually using up the full amount of leverage of that 50 to 1 based on the assets that they actually have on hand. So here's another example of some of the investment banks and their assets under management. These are in billions of dollars, so you can see JP Morgan is the largest there, 2.4 trillion total assets there. You've got Bank of America, 2.1 trillion, Citi, Wells Fargo, Goldman Sachs, 923 billion. The list goes on. So, we're not dealing with little banks or institutions. And if it goes back to 70% of their assets are being traded in the market, you can see why we pay attention to what it is that they're doing. So to show another very clear example that all investment banks are doing the same things, there was a former head of Goldman Sachs U.S. equity derivatives business in Europe. He operated Europe, the Middle East, and Africa. His name's Greg Smith. You can look him up, Google him. He explained in a university lecture that with governments promising to instill regulation on the big banks after the 2008 financial crisis, still have less than a third of the act that they had put in, called the Dodd-Frank Act, has been implemented. 3/4 of the deadlines of the bill have been missed, and $400 million has been spent lobbying against the bill. So there's a clear indication, obviously, that the markets are here to stay, and as well as the banks getting even bigger than they were in 2008. So more money moving into the market. So Goldman Sachs is a U.S. investment bank, also assets under management of 861 billion as of 2015, and they have over 80% as of 2013 in trading. So they also had a $10 billion bailout in 2008, as mentioned. And there's another correlation that you can see that these banks are all trading in the markets with most of their capital at risk. So with 75% of total Wall Street revenue coming from trading, the biggest players at the table are the pension funds, investment banks, charities like the Red Cross, university endowments such as Harvard, Yale, governments investing hundreds of billions of their dollars in Wall Street firms to trade. And CNBC has quoted that in 2014, the hedge fund industry alone had over 11,000 hedge funds with total assets under management of 2.6 trillion. And those are just hedge funds, those aren't investment banks, with on average 236 million per fund. So the top funds control most of the funds, with some of them having over 150 billion assets under management, like Bridgewater. And this represents the hedge fund industry alone offers enough liquidity to keep the market going in itself, with thousands more investment banks, prop trading desks, and large firms. It's the most lucrative industry in all of finance. You'll be able to see that very soon. So some of the top trading firms outside of investment banks are, here's a list of them. As mentioned, Bridgewater Associates, as of last year, 2 years ago in March, they had just about $170 billion in assets trading in the markets. There's a big list here. You can look up some of these firms if you want. Come back to this once it's recorded. Here's another list of some more firms. This one is a little bit dated. As you can see, Bridgewater is on that list when they only had $87 billion assets under management. But also you see some investment banks on here as well, with Goldman Sachs and JP Morgan. These are their subsidized hedge funds. So that's not actually the investment banks. These are just some of their hedge funds. You can see BlackRock there also is a investment firm that has 5 trillion assets under management. So you can see they diversify in a lot of hedge fund groups as well. So how Forex became, the reason why a lot of you are on this call today and you heard about Forex is how did it become as large as it is, comes back to, what is the majority of trading come from, right? And that's obviously the US dollar is the most powerful, country in the entire planet at the moment, and then second would be the European Union, pretty much, right? So when and why was the euro created is a great question to ask when it comes to Forex, because it gives you a lot of insight on how this market came to be. So the European Union introduced its new currency in January 1st, 1999, the euro. Originally, euro was an overarching currency used for exchange between countries within the Union, while people within the countries continue to use their own currencies. So obviously, pairs, as Ted was mentioning earlier, Euro USD, there's a lot of Euro pairs, a lot of US pairs. So that's where a lot of the volume comes from. So that brings us into a little bit about price action to begin with. So some quotes here from some of the top books on investing. This is one called Inside the House of Money. Top hedge fund traders on profiting in the global markets, Stephen Dromby, billionaire. He mentioned the collective knowledge of a group of people is always higher than the individual parts. So even recognizing for experts, price action tends to confirm that. So the price action never lies. So what you can take away from this is that price action is more accurate than trying to articulate a vast amount of fundamental data from a variety of different sources. It's obviously what Ted has shown earlier. You really can just look at the price and have a pretty good understanding and clear picture of where price is likely going to go towards. So 75% of price movement happens only 10 to 15% of the time. You'll learn that very quickly once you have started trading the markets in periods of consolidation and so on and so forth. You'll see that there's a very short amount of time that price actually moves massively, and then the rest is, as it says here, nothing but noise within a range. So the 10 to 15% is where we focus the bulk of our entries. The next quote is from George Soros. He's the richest hedge fund manager in the world, also known for making over $1 billion shorting the Great Britain pound in a single day. In his book on the theory of reflexivity, he talks about theory of reflexivity in his book, The Alchemy of Finance, stated that when it comes to the markets, the participants' views influence the course of events, and the course of events then influence the participants' views. So it's a self-fulfilling prophecy. When explaining the cycles of the market, which explains that as traders, the number one common trait is to trade with the trend. And as traders pile on orders trying to get the most returns out of the market, the fundamentals that cause the trend in the first place is typically then surpassed, and then the fundamentals change again, once again. So from being forced to be revalued from the massive surplus in underlying economic predictions. So since this continuously happens in the market, technical analysis side of trading can become valued higher than the fundamental side. So that's why you see most traders focusing more so on technical data rather than economic and fundamental data. So we're going to talk a little bit about economics first, then we're going to be getting into some technicals as well. So the definition of what economics really is it's a description and analysis of the production, distribution, and consumption of goods and services of a country. It's very simple, right? So what's happening in an economy. In order to analyze how much you think a country's currency is worth, you need to evaluate the economic situation of the country in order to more effectively trade currencies. Simple, makes sense, right? Very, very logical. So economic indicators are reports that detail a country's economic performance in a specific area. These reports are usually published periodically by government agencies or private organizations, as we'll be talking about later with some of the sites that you go to view the most current economic data. As Ted was talking about earlier, most traders just call it news, right? So what news is it's economic data that's factoring into what you're seeing in the charts and trading. So here's a little bit of what had happened this week. A lot of traders made an absolute fortune. Some of the biggest firms out there had some of their biggest days, if not in their lifetime of their company, or in that single day or for this year, right? So as interest rates was released this week by the Federal Reserve, there was an interest rate statement in the United States increasing their interest rates 0.25%, but the statement that Janet Yellen, who is the head of the Federal Reserve, had given had propped the market up a massive amount, as you can see here. With this being on a 4-hour chart, each candle representing 4 hours of activity in the markets, you can see that there's one massive green candle compared to, the, if not 100 previous candles there that you can see on the chart. So you can understand, the importance of what was it that happened in that single event and what was it that changed from that downward cycle that we were in to now very, very bullish nature in the charts, right? So this is something that you're going to learn the importance of. You don't need to fully understand it right away in the beginning, but you can clearly see that there was something massive that happened, and most people would want to know what was it that happened, right? So a little bit about this was on the 15th, the Fed, as I had mentioned, had raised interest rates in the United States due to inflation, which we're going to talk about in a little bit here. So as you can see, the US dollar index and interest rate correlation did the exact opposite. So as the as the US economy raised interest rates, it dropped down the US dollar, right? You can see that massive red candle there, and it propped gold up. This is gold, by the way. So gold went up from an interest rate statement, and the US dollar went down, right? So there's a little bit about correlations that you'll learn as you're continuing on, but that's just one of the correlations. Comes back to what Ted was talking about with gold as a safe haven. As there is uncertainty happening in the United States, people move into safe havens as basically an insurance policy, right? We'll talk about that in a little bit. So here's some economic data regarding interest rates from PIMCO. They're a very, very massive institution managing trillions of dollars. So this is a little chart that shows you the blue line is inflation in the United States, and I'm going to describe what inflation is in the next couple slides. Then you have the yellow line on the chart, which is unemployment. So you can see that as unemployment rose, inflation was down, right? And then as unemployment came down and was low, inflation started to go up, right? So what is the correlation there, and how does that affect interest rates? So you can see here is another quick chart. Gold and the US interest rate correlation. So as interest rates on the left-hand side of the chart were going down, gold was going down as well. And as interest rates start to go up, gold starts to go up also. So you can see the identical correlation that depending on what's happening with interest rates, you can look to the charts and find amazing setups just due to simple correlations such as inflation. So how interest rates play a role in Forex, as I mentioned, when the amount of spending and income in an economy grows faster than the production of goods, prices obviously rise, right? We have a little thing here in Toronto where, a lot of people are making a lot of money and a lot of people are buying a lot of real estate in Toronto, and the prices are going up. They're inflated. You get a condominium there for $1 million. Is that condominium really worth $1 million? Does it cost $1 million to make that condominium? No, it doesn't. But because prices are inflated in the area, people are willing to pay that, right? So that's not typically a good thing long term. So that's just an example of what inflation is. So when prices rise, the economy enters into an inflationary stage. The central bank doesn't want too much inflation because it causes problems, as mentioned. And then as the central bank, which is the Federal Reserve in the United States, sees prices rise, it raises the interest rates, which they just did on the 15th of March, which you saw in those chart examples that I had shown. So with higher interest rates, fewer people can afford to borrow money, and then the cost of existing debts rises. So, things as mortgages, it'll be more costly as far as the interest on your mortgage will go up. And then for people that already own assets, that own things such as mortgages, their interest rates also go up. So it costs more to service the debt. So think about this as the monthly payment on your credit card simply just going up, right? That's basically what interest rates are. So because people borrow less and have higher debt repayments, they have less money left over to spend. So spending in the overall economy slows down. And since one person's spending is another person's income, incomes drop. And then so on and so forth. And then it's a downward cycle, which leads to recessions and depressions and so on and so forth. So therefore, as U.S. interest rates go up, the U.S. dollar weakens, and investors move into gold as a safe haven to also as an insurance policy against a weakening or inflated U.S. economy. So it's going to get in. We're going to get into some of the institutional things that we actually look for as far as the charts. The first one we're going to talk about is institutional sponsorship and why we want to be on the right side of the market and how to tell what side of the market the institutions are on so we can be more correct than not. So who are the institutions? As mentioned earlier, they're investment banks, large-scale funds. Why is it important to understand how they function? Because as retail traders, we need to understand that we have no impact on the direction of the market and the way that it moves. Only large institutions can do that simply because of the size of their trades. And that goes back to showing you how vast their assets actually are that are being traded in the market. So an investment bank can have over $1 trillion in assets under management, if not more. Where their funds come from is mainly 401ks, pension funds, large-scale charitable organizations, as mentioned, like the Red Cross. Because they have access to these funds, 70% of their assets are being traded on the market as a whole. So the first thing we're going to look at is the top-down analysis when it comes to trading in the charts, things that all of our top traders start off with typically at the beginning of the week and continuing on week after week. So you always want to conduct your analysis from the highest time frame down. So you have the daily/weekly chart. You want to find your long-term directional sentiment. You can use the 4-hour chart to plot your support and resistance using about 20 days of data, determine trading conditions, and then use your 1-hour chart to narrow down the entry based on your strategy, and then finally the 15-minute chart to execute your trade by determining precise entry points. So the next thing we're going to look at is range trading. So what is a range? Range is a high and a low of a set amount of data in the charts. And as price begins to respect these highs and lows, it begins to bounce between the range, just as if you're playing Pong. So it's just bouncing up, down, left and right. So most beginners aren't aware of the range, therefore they can get trapped in buying high and selling low. That's what we want to try to avoid, is buying when it's not time to buy and selling when it's not time to sell. It's like real estate. You don't want to be buying at the top of a market. You want to wait till it crashes to be buying. It's the same thing with trading. So the objective of range trading is to buy low, sell high. Another problem beginners have is closing trades. Because they have no idea of the range, this can lead to gambling and marrying trades, not exiting when you should and holding on when you shouldn't. So when trading in the range, make sure to determine your take profit point always before you enter. So here's an example in the charts of what a range looks like. You're going to see this pattern over and over and over again once you start your trading. The bottom line there is what you can call a support. Top line is your resistance. And then you have that nice range where it pretty much goes to the same area on the top every time and pretty much the same vicinity on the bottom. So the bottom's where you can set up some nice buying opportunities and the top is where you can be selling. So what consolidation really represents when the market's not doing anything, it seems, when it's just sitting there, it's not moving, there's no volume being traded, it looks like, it's not appeasing for retail traders to be in the market, right? We want to make money in the market. We don't want to sit there and just have a trade that's just stagnant, right? So what institutions, when institutions and market makers cannot fill their orders unless they have liquidity, they also do not want people riding on their coattails, right? Because then you're taking liquidity away from them. So once they have the liquidity they need to move price where they want, significant moves in the market that's when they occur. So in order for the market makers to hide their massive positions, they slowly add in their orders as price is either moving in the opposite direction or of the trend, or by filling their orders during consolidation, right? Because the thing is that their orders are so big that they need to either be hiding their orders or putting them in when they can put them in because they need the liquidity. So why retail traders view consolidation as unappealing and an unappealing time to trade, which allows them to be stacking their orders and sneak them into the market basically when no one's looking. So consolidation, when the market makers are able to fill their massive orders broken up one block at a time to lock in the best price. So when they have the majority of their positions filled, they're able to put that last bulk of their orders in all at once, and then that's what causes the extrapolated moves in the market. So here's an example. If you look in the first blue box there, it's pretty unappealing. Like if you're, let's say you're swing trading this at 15-minute time frame, not too bullish, not too bearish. It's just moving sideways, right? I mean, there's some scalping opportunities in there for sure, but you can see in that time frame, you have the market going up a little bit, down a little bit, right? So that's the market makers are stacking orders in there of which direction they want the trend to actually be going in, right? So you can see just up and down, sideways, and then as we get to the right green box on the screen, you can see that massive move of 115 standard pips or 1,150 micro pips. And there you go. By having the higher time frame bias, that would have been a nice profitable move, right? The overall direction of the trend. So that's where the market makers are hiding their trades within a consolidation. So the next topic is buying dips and selling rallies. So you have retail traders generally that have the herd mentality and chase price action. So they're chasing price. They don't know which direction it's going in. They just want to be in and out of the market. They don't really understand what's going on. They just, come home from work or whatever they were doing for the day. They see price moving down. They take a sell, right? They buy, they sell based off impulse, depending on the direction price is currently moving. And typically that's on a very, very small time frame. So for example, a new trader may have just got home from work, as mentioned, decides he wants a piece of the pie, enters in the market anytime a large move had already occurred, right? So that's the wrong thought process, which can result in large losses due to late entries. So market makers place the bulk of their orders during reversals against the overall trend. And when trading your strategy, the best time to buy is when price is making a dip, if it's in a bullish market, bullish sentiment. So a dip down in price, and the best time to sell it in a bear market is obviously when price is rallying up. So here's a little example here with a bullish trend. The market makers wait for 1,067 pip reversal, buying on a dip down in price. So boom, you see price go down. In a bull market, dips down, that would be the best time to typically buy, right? So then as we move to the right side of the chart, you can see as the market trend begins to shift bearish, the market makers wait for that rally back up, about 1,327 pips, reversal to continue their entry, selling as the price had rallied back up. So by buying the dips and selling the rallies, the market makers ensure they're getting the best price. So trading with an edge. So this comes down to obviously more confirmation or confluence is a higher probable trade. But you want to try to avoid too many indicators on your screen as the indications can begin to contradict each other. So stick to a strict trading strategy that uses the same confluence factors every time. And with the proper strategy, this is what's going to give you an edge over time. And what you want to typically be doing is session trading. So we're going to talk a little bit about that, where you're trading the pairs, your currency pair, within the current trading session. The market tends to retrace before the open, followed by the move with the trend after the open. Now, why does this happen? Now, what is an open? We're going to talk a little bit about an open in a minute here. So why does this happen? Most volatility occurs upon the opening of each session. Therefore, the market makers begin pricing in at that time. And like we've said, they're getting a premium price. So as the sessions close, institutions begin to cover their positions, close them out, and take their profits, right? So what is the opening or a close of a session? So we have a little chart here of the Forex market times. You've got London. This is Eastern Standard Time, this chart, so it may be dependent on differently, dependent on where you're from. So 3 a.m. here in Eastern Standard Time, Toronto area, New York, is when London opens. So then you have London open from 3 a.m. till 11 a.m. Then you have New York crossing over with London from 8 a.m. till 4 p.m. And then from 8 a.m. till 11, you can see London and New York is open. So that's a very, very peak time of volatility. And then you have Sydney from 5 p.m. till 1 a.m. and then Tokyo from 7 p.m. till 3 a.m. So weekly insight. How do we view our trading week after week, right? Just rinse and repeat. So Sunday typically is when you want to start your analysis for the week, if you haven't done so already on the closing of Friday. And then Sunday to Monday is generally very little directional premise. Tuesday's London session is generally the high or the low of the week. That's a probability, not a guarantee, but you will find that Tuesday is typically when the market has the high or the low of the week, depending on what the overall direction of the trend is. So Thursday is typically the reversal for the week as institutions close their positions, as Thursday for us here in Canada or in Toronto is Friday morning for a place like London. So they're closing their positions out as the day is going on. And then Friday, bank traders have already began their weekend. This means there's going to be low volatility, and you want to be careful of getting caught in a trade over the weekend as the market tends to gap. You want to be careful of that. And there's also news over the weekend. So Tuesday having a 70% chance of being the high of the week. You can see here Tuesday's London session. This is a bearish trend, obviously. You can see Tuesday was the high of the week, and then you can see in the second box here we have Thursday's trading, which was the reversal of the market. So as institutions are closing their trades out, close them out, and then take their profits, which results in the opposite side of the trade pushing the market up in a downward trend, right? If you're closing your position and you're in a sell, that's going to act as a buy position because somebody has to buy it, and then vice versa for selling. And vice versa for buying, sorry. Institutional order zones. So what are these? It's a region where banks value price and stack the bulk of their massive orders. Order zones occur in trending market conditions. Bullish order zone is large bearish body with small wick. It's typically the last bearish candle before a very, very large move up. And then the opposite for bearish order zones, which is a large bullish body with a small wick. And it's the last bullish candle before a very large move down. So bullish institutional order zones here is an example. So you have the first arrow there on the bottom, the last bearish candle before the large move up. And then you can see as we move on to the second arrow to the right, price goes all the way up, came back down, touched right into that body of that first bearish candle, the red candle before the up move, then bounced off of that very, very massive move, comes back down, and then the new order zone there is that second bear candle before that big move up, and then price comes back down, bounces right off of it. So for a total of a 4,052 pip move. So price action comes back, taps into that, and it's an opportunity to buy, right? So you want to look for that in up moves. It's the last bearish candle before the massive up move for price to eventually come back to that point as a great place to buy. And then here's a bearish example of institutional order zones. It's the last bullish candle before a massive movement down. You can see as price starts to move down away from that area, starts to reverse back up, comes right back to where that bullish candle was before the first leg down, taps into it, starts to move down, taps back into it again there with that wick, and then boom, you can see that massive gap down there, huge, huge gap down, 5,198 pips. So these are typical areas that we base a lot of our entries on, not only when we're scalping, but swing trading also. So here's a monthly institutional order zone. You can see here this was on gold. You can see that last bearish candle, and these are significant, obviously the most on the highest time frames, but they work on the lower time frames as well. So you can see that last movement there, bear candle before that massive green movement up, is where institutions place the last bulk of their orders before that big movement up. And you know that the next time the price comes down to that level, it's going to shoot away from it again. There's going to be a high probability that's going to happen. And then that's where you can catch very, very vast moves. So here's another example. This one's on US CAD daily chart. You have that bullish trend in that last bearish candle. Price jumps away from it, comes back down, taps into it twice, and then expect that next movement forward going bullish again. So what are stop raids and liquidity pools? So institutional traders' main job is to provide liquidity to the institution. The institutions move the market, therefore they cannot buy if somebody is not selling, and vice versa. Market makers will move price to specific areas to hunt for liquidity and raid stops of the large funds. Finding these areas are significant and give the ability to catch very, very large moves. So liquidity pools can be found on all time frames, but the higher the time frame, the more significant the raid will be. Stop raids can push you out of the market by closing on your order, even though your intended direction was correct. Just that quick, massive candle down, hits your stop loss, stops you out of the trade, then goes in the direction that you had assumed. So time in front of the charts will give you more clarity of when these stops will have happened, but there are some examples that we can go through here. So everywhere there's a bullish X or a bearish red X is an area of clean support or resistance. Since banks know the majority of stop losses will be placed above or below the previous high or low, they raid these areas, which provides liquidity for their massive moves away from those areas that follow. So you can see there, you have that first blue X there on the bottom, you have that support, and then price respects it, then you see a wick go right through that line. That's what you can expect as your stop raid. Typically the last low, so that first wick there to the left, would be a low that was made on the chart, and then traders expecting that bullish run. You can see it wicks down, hits most of the stop losses, then they have all that liquidity and they jump price right back up. So it's the same thing for the next X. There you can see the second blue X. You have price come down, make a nice support off that level, then that second red candle shoots the wick right through it, stopping anyone that would have their stop loss right at the bottom of that wick, right? So then you see price go up. So to the third blue X, you see a nice support made there. You can see we're in a trend here where we're making higher highs and higher lows, makes that nice support. Then the two red candles, that second red candle comes right below it, stops anyone out, then boom, massive movement away from that back bullish. So then we go to the red X. So now on the downside, as we're in a bearish market, bearish sentiment, you can see this red X. It marks where people would be having their stop losses in sell orders. So, let's say they caught a very nice position there towards the top of this sell-off, and they're moving their stop loss down accordingly. They're going to want to move their stop losses down to where the previous lows are. Right, so as they're making lower highs. So as they keep making lower highs, move your stop loss down, lock in more profit. Price starts moving down massively. Then that second red candle there shoots right back up. That wick goes above where most people are going to have their stops out, and then price shoots massively down again. And then there's the third example. Obviously, it's self-explanatory now. You can see that happened again. So very frequent that this happens, but like I said, time in front of the charts, you really start to see this stuff happening over and over. So fake outs. Fake outs are the next thing you guys are going to want to pay attention to. And don't worry, as Ted said, if you guys aren't getting all this right now, I don't think I have the ability to answer any questions at this point. I don't think I have access to the question panel.
No, there was a couple. Sorry, Dave. There was a couple just in terms of the charts. If you can sort of scroll with your mouse, just so that they can keep track with things. That's about it. But yeah, other than that, everybody's good.
Problem. Okay, good stuff. So, as mentioned, this will be recorded so you guys can come back and watch this, and you have any questions, feel free to reach out as well. So, fake outs are very common in trading, but they're not what the retail world thinks of as a fake out. As stated earlier, the banks need liquidity to trade, so they will manipulate price to fool the majority of traders to enter in on one side, then move price with conviction totally in the other direction. So, it's like a basketball fake out. You go move one way, and then slide to the other side and people are breaking their ankles. It's the same thing that's happening in foreign exchange. So normally after 12 p.m. Eastern Standard Time, you'll see price move in the opposite direction of what your analysis states. This is a topic that we train in our private training groups, very, very in-depth topic, but this is typically what you see. Your analysis against your analysis in the direction of the trend, and this normally will lead up into London session before you see it turn into the actual direction, which ends up stopping the majority of retail traders out, confusing them, and makes them think, oh, Forex is rigged. So we can show some examples here. So as price was moving in the up direction, you have that last low there, as mentioned before. Just over 20 pips below that is where you would have your typical stop loss for the majority of traders, 20 pips stop. And then as price goes up a little more, fakes everyone out. They think they're in that buy order, the trend starting to trend up, they're maybe in some profits, and then you see boom, price spike right back down, right down to where that stop loss would likely be placed, hits that little liquidity pool there, and then this is what we call a fake out. So it's a suspected area where stop losses will be, triggering buy stops for the market maker, right? So price moves with conviction the opposite direction, fools traders to think price is going to be going short. So what is the difference between a retail mindset and the institutional mindset that the banks have? Well, retail traders do not move the market, obviously, once again. Only large-scale institutions and funds have the ability to do that. To move a country's currency, as simple as 1 single cent requires billions of dollars of liquidity. So, for example, most traders will only trade up to, let's say, 10 lots. Maybe you have people in Ted's group that are doing about 100 lots. Whereas institutional trades are about 2 million lots or more on a bad day. So banks need all the liquidity that they can get, which is why they do not like traders riding on their coattails. It's just taking money away from them with the liquidity. So the majority of Forex knowledge that you'll find on Google is herd mentality, and easy for the banks to manipulate and push people out of the market since the retail traders are doing all the same thing. They're all taught the same indicator, Google, everyone is doing the same thing. But luckily you guys are on this webinar. Now you're going to be very, very informed. So to think like a bank, you must fully understand price action and how banks trade. We've touched upon some of the ways that they think, which leads us to the next segue of that topic, which is premium price. So institutions and market makers are greedy. They like to get the best price that they can when it comes to trading, so they'll move price to that area multiple times, getting the best returns. And then this is what we've already listed as institutional order zones. This is another example of it. So market makers will continuously drag price back down or up to specific areas where they're factoring in their best price point before they move price with conviction away from that area. The reason they do this is to hide their block orders that they're placing, as well as get an entry at the cheapest price and make the most money on. These levels are very clear to pinpoint out, and you'll have an understanding of price action from an institutional perspective, which can be profitable very, very, very much. So here's a premium price candle or a bullish order zone. So you can see that last red candle with the least amount of wick prior to that massive movement up. See if I can move my mouse a little bit over here. So just down below this level here, you can see, boom, price just shoots massively up away from this level. All right, then price comes all the way back here, and the market makers enter in the same spot multiple times, giving them a premium or discounted price to enter, allowing them to stack orders before a big move. Once the bulk of their orders are placed, you see a large move with conviction away from that area. So you can see price moves with conviction away from this area here, taps into this zone where we first saw the biggest move away from it, comes back into it, taps into it once, comes down, taps into it again, third time taps into it one more time, and then it starts to move massively away. Now this would typically be a good entry. It doesn't really matter depending on your lot size and your account size. You want to use accordingly use your risk, but you could get in here anywhere within this block here, and this would be a great place to enter into the trade, right? And as you can see, as they're stacking their orders here, they keep dragging price down because they're making the most money by capturing the move from here, not from up here, right? So as they're stacking price, you can see price starts to move away from that area. You'll start to see these in your trading once you spend some more time. As mentioned, don't expect to get this stuff right away. So the higher time frame obviously is going to give you confluence of higher probability. So when trading, it's very important to use the higher time frames to build confluence towards a trend direction so that you do not get caught on the wrong side of the market. So you want to picture a higher time frame as sitting in a room. Let's say you're sitting in a boardroom. You have 100 of your professionals that are telling you something is correct in one of your questions, or sitting in another room with a single person trying to desperately convince you that it's wrong. So that's where the fake outs happen, where you could see price going down, and that's where the fake outs happen, where it looks like price is going down. You get caught on the wrong side of the market. So the 100-to-1 ratio here is you have a time frame that's a daily time frame, a weekly time frame, and a monthly time frame. You've got a lot more confluence in the higher the time frame because it makes up a lot more of time in that period. So when looking only at the lower time frame, it's easy to get confused or lose sight of which way you should trade if you don't have the higher time frame bias. So it's a weekly time frame of Euro USD. Each candle obviously represents a week's time. So rarely do higher time frames range trade. So having a higher time frame directional bias leads to a higher probability of being on the right side of the market and leads to more wins than losses and more conviction. So with a higher time frame bias, you can drop down time frames and trade in the direction of the trend, making you more consistent. So you can see here to the right of the chart, you just have that smooth bearish downswing where anywhere throughout that time you could clearly understand that the market is going to be continuing a downward trend. So you wouldn't want to be obviously a swing trader and be a bull in a market like that. So the big picture here. So in 2015, we're just going to go through some statistics of some of the top hedge funds. The 2015 top hedge fund manager earnings, number one was Kenneth Griffin of Citadel Securities. This individual owns a hedge fund, a trading operation, a trading firm, and they trade all the markets, including obviously mutual funds, stock market, and majority of currency trading as well, right? So they all interconnect with each other, but currency is one of the big asset classes that a lot of these fund managers trade. So you can see these are just a single year's earnings for some of the top fund managers. So depending on what it is that you're really looking to do in this industry, your career can scale to the highest level or anywhere in between. But there's literally, as I think Rag said it earlier, there's no limit to what you want to do in this industry. Obviously it takes time, it takes effort, but the possibilities are wherever you really want to take it. And that's what we're looking for, is we want people that really take this seriously, because we have next level stuff that you could be introduced to as well. So and then that brings us to our conclusion. So we have an upcoming platform. I know a lot of you are probably a little bit confused on some of the topics that were spoke about in this session. Just from our section, this was mostly advanced institutional insight, economic data, a platform that we have that's coming up soon. We have a website. What we're going to be doing is you're going to have the most up-to-date economic insight and information regarding the foreign exchange. We have connections globally to all sorts of organizations, including hedge funds, investment banks, and the most up-to-date economic information from actual Bloomberg terminals that the top institutions use. So these are some of the tools that we use to actually have the most current analysis in our trading to keep us with that edge at all times in the market. So this is something that we convey to all of our members that are part of what we're doing. Obviously, we're working together here with Ted, so that's something that we're going to be coming to basically a unit of getting this together on this platform so you guys can have the most up-to-date information. So we also have currently over 10 levels and tests for traders of all experience levels, from advanced topics such as some of these to really, really, really in-depth topics that we did not even speak about here. Really, it depends what you want to do with your trading, right? So some individuals like to learn a little bit more, and that's what we specialize in. So we also have a live proprietary chat room on our website, a forum with all technical analysis and updates, economic fundamental updates, and live daily sessions from our top traders who have made anywhere from 6 to 7 figures. We're working with some traders that also have access to the equities market. So if some of you were interested in that as well, we also have some traders from the States there that have a lot of experience that we've collaborated with now that have 6, 7 figures out there. And you'll be able to see live analysis just like we were going over today. And you'll be able to ask any questions that you have, similar to the way that this webinar is set up, but on a daily basis with our traders. And you'll be able to rewatch those videos that will also be recorded. We also have an incentive program that we are putting together for our top performing and most collaborative members. Obviously, as you can see, Forex is very profitable, so we want to make sure that we're spreading that around. And then there's much, much more. So this is stuff that's going to be coming soon. We're going to be working together directly with Ted to have this brought to you guys in the most professional manner. It's really the next level that we're looking to do. But I just want to pass it off to Ted quickly to just give you an overview of what we're really looking to do with this platform as we work together on it.
Yeah, thanks, Dave. I'll keep you unmuted if you want, or if you want to self-mute, just
Yep.
go ahead.
problem.
There might be some questions, or if there's issues.
You can talk, and then I'll just show in the background a little bit about the site while you're.
Yeah. Okay. So Dave, this is sort of his brainchild, and like I said, Dave did say we've been working a while together, and he is actually he's part of the private equity firm that we own together. So this was something that we were thinking of, and it'll be open to all the Forex family members. And this is something that we don't know the timeline specifically, but it's it's in the works. We want to make sure that we have something that will be sort of the next level for everybody that is going to be part of this. And it's just a combination of a lot of information, a lot of ideas out there. And since everybody's looking for specific mentors or specific training, what we were really trying to do here is build out something where if people wanted specific one-on-one training, or if they wanted to do other information, or they wanted to have other things given to you, we were thinking of doing some sort of small token program where maybe there's you pay a monetary fee for like a half an hour or an hour session with people, see how that works. You as a trader could also then be on there and also educate people too. So I mean, it's just something that we were looking at as well. So I mean, we're going to definitely look a little bit deeper into this, and if there's any suggestions that people want to see with various ideas, I mean, we'll be open to them. But like I said, this is sort of something that's in the works. Dave's worked very hard on it, and we're just trying to tweak it for everybody in the group so that you guys get the most benefit out of it. Just because, I mean, at the end of the day, we do like a simplistic, Facebook group, and there's WhatsApp groups and things like that. So this is just the next level. For right now, I think in terms of costs, I don't think there'll be. I think everyone will be grandfathered into the system, and then we'll figure out something accordingly. But like I said, it's in the works. We're working on it, and we'll meet with everybody, and there'll be feedback in the groups on what people want and what they don't want, and we can go from there. But it's just something that Dave's been working on. He's very astute with institutional trading, and I think a lot of you guys, if you saw the this past half hour, it is a lot to take in, but also at the same time too, as you start to understand trading more, you know you'll see how much of a benefit this is actually. So I mean, like I said, and Dave said the same thing, it's a lot to take in right now, but as we move forward, you'll find that it'll be pretty straightforward, and it'll just be an additional to your repertoire and also your education. So Dave, I don't know if you had anything else you wanted to talk about, or if you're good.
That's everything, Ted. Thank you.
Okay, perfect. Thanks a lot, Dave, once again, and we will be chatting with him, and he'll also be available to help you out. And like I said, he does private mentorship. He's super busy just with the firm and just running things on the side for himself. So he's part of the family, but he's more of like a cousin. He's around when you need him, but he's not actively as involved. So don't really pin it against him if you can't get a hold of him all the time. He's super busy with the firm, and no offense, but that's where we're heading, and we will obviously want you guys with the firm with us as well if you do want to take that opportunity. So you'll get to meet him and greet him a little bit more there too.
For sure. I look forward to meeting everybody.
Yeah. So with that being said, I'm going to jump back on, and I'm going to